Good afternoon, Laura School Middle School students. This is Mr. Corey, your college and career advisor. Today we're going to talk about the fundamentals of investing. I'm going to go through this kind of quick and just give you an overview because we'll talk about this more throughout the school year and you're going to learn a lot about it. Many of you may not know about investing or what investing is, so we're going to go through this presentation and discuss what it is. It is a very important tool for building wealth and helping you to increase your net worth as you grow older. So an investment is an asset purchased with the goal of providing additional income from the asset itself, but with the risk of loss. So within a financial plan, you have a savings account for emergencies. This is connected to your bank, your savings account, and then separate investments. Investments are something you purchase like a stock or a piece of real estate. And the goal is that it will provide you additional income. But each investment that you make also comes with a risk that it will lose money. All investments have some risk, okay? And here are three terms you need to know. A return is the profit or income that's generated by saving and investing. So any money you make off of an investment, that's your return. Trade-off. Higher returns usually equals a higher risk. So if you purchase a stock that has a higher chance of getting a greater amount of income for you, it normally comes with a higher chance that it will lose money as well. Your investment risk is the possibility that an investment will fail to pay the expected return. So if you invest, you expect $100 and it only pays 40, that wasn't good, and that's an investment risk. Investments do have the potential for higher returns. That's why investments are something that you do in addition to saving. So investments are important to building a net worth. Okay, you have two things. You have saving tools, okay, and investment tools. Savings are something that can be quickly and easily converted to cash. We call those liquid investments, quickly and easily converted to cash. This is any cash you have on hand and whatever is in your checking and savings accounts, okay? Those are items you can get access very quick and turn into cash. Investment tools may not be easily converted to cash, or if you do convert them, you can have a penalty charged to you if you access the funds too early. So investments are meant to stay there for a long time and build net worth over time. Net worth is attached, each person has a net worth, okay? It's your assets, whatever you own that has value, minus your liabilities. That's whatever debts you have. So your home mortgage is a liability. That's what you owe. But the value of your home could be an asset. So if you own a home, you owe $200,000 on it, but the home is worth $250,000. Well, technically for that, you have an asset of $50,000 because you have $50,000 more in your home than what it's worth. So you and are in a good spot. So keep in mind assets and liabilities for your net worth. Investments are less liquid than savings, basically meaning you cannot convert them to cash as easily. That's why we tell you to have both in your portfolios. Investments help accomplish long-term goals, okay? So this could be buying a house, higher education like college, or your retirement. Most people use it for retirement. This is what most financial advisors recommend, 10% of your net income. Okay, that's after taxes, deductions, anything like that, whatever you have, your take-home pay. It's dedicated to savings and investments each time you receive a paycheck. You may not be able to do that amount. You may be able to do more, but we do recommend do whatever you can to put a certain percentage of that net income into savings and investments. So there are two different things. Saving, again, or savings accounts that you have can be converted to cash quickly. Investing cannot be converted to cash as quick. All right, you have a savings account for a couple things. Emergencies. If you need to get cash really quick, you can do that. Very low risk. You put it in there, it's there. Lower returns, 0 to 4%. Most savings accounts don't even hit 4%. They're for financial security. If you have a savings account, that gives you a safety net. Investing is for a long-term goal like retirement. You cannot just get the cash out very quick. They are higher risk. You have a potential that you lose money, but in turn you have a higher chance of return. They can get 8 to 12% on good investment accounts, and they are to build your net worth. Okay, think about when you save or invest, or just thinking about you saving and investing in your future. How does it make you feel? What do you think about when you think about doing that? All right, we're going to talk about a couple terms here. First thing is rate of return. Okay, total return on investment expressed as a percentage of the amount of money saved. Okay, so your total return, let's say you made $50, divided by the amount of money you invested, so $100, equals your rate of return. Okay, here's an example. Mandy saves $2,200 in a money market deposit account. After 1 year, she has a return of $110. Let's take a look what her rate of return is. So $110, that's what she profited, divided by the $2,200 she invested originally equals 0.05 or 5%. That gives her a 5% return on investment. Okay? Now, inflation. This is something that will affect you in your daily life and as you budget in your future. All right, it's a rise in the general level of prices. So if bananas all of a sudden cost $1 more than they did last month, their value inflated. All right, inflation risk when you invest is a danger that the money you invest today won't be worth as much in the future. So how does inflation relate to investing? Well, the risk is if you invest $100 today, everything inflates. In 10 years, that $100 is not even worth $100 anymore. It can only buy $50 worth of goods because everything else is so much more expensive. So what you want to do to try to avoid that, when you are working with a financial advisor or even looking at financial articles on the internet, there are inflation rates and they do change. So try to get a rate of return on your investment. Invest in something that's higher than the rate of inflation. So if the inflation rate is 3%, you want an investment that has a higher rate of return than 3%. Think about what you already know about each investment tool as we go through them. You have bonds, stocks, real estate, speculative investments, mutual funds, and index funds. Okay, a bond is a form of lending to a company or the government. So basically, if you buy a bond from a company, that company is paying interest to the lender, which is you, until the maturity date is reached. A maturity date is whenever the bond is finished. Okay, so if you buy a bond for 4 years, at the end of that 4th year, that's your maturity date. The organization is going to pay interest to you until that date occurs. Your investment risk is very low. You're not really going to lose money, although some bonds are more risky than others. The return is a fixed interest rate, so it may be 6% interest. You're going to get that 6% interest rate throughout the entire term. Maturity date, again, specified time in the future, when the principal amount of the bond is repaid to the bondholder. Okay, so that's whenever the end of the term is, that's when it is. All right, stock. This is one of the most common types of investments. It's a share of ownership in a company. All right, the stockholder or shareholder is the owner of the stock, which would be you if you purchase stock. Okay, usually a stockholder owns a very small part of a company. So if you buy one stock of Amazon for $100, you're a shareholder in their company. Stock returns, any money you make off of a stock are divided into two different things. Number one is called a dividend. Okay, a dividend is a share of profits distributed in cash to stockholders. So if you buy a stock that pays you in dividends, you buy a stock for $100, you make $50, that $50 is called a dividend, and it's coming back to you in cash money. You're actually going to get it in your hand, cash money. Okay, so stockholders may or may not receive dividends because some stocks give you capital gains. Okay, so we're going to look to it here. Market price. That's a current price a buyer is willing to pay. So that's whatever the stock is selling for. So if a stock can do two things. It can sell for a price higher than what was paid, which means you pay $100, you sell it later for $120. All right, that's a capital gain, which means you have unearned income received from the sale of an asset above its purchase price. You receive that $20, but it's not coming back to you cash in hand. Okay, there's another option that a stock sells for a price lower than what was paid. That's what you don't want. All right, and you will lose money if that happens. So, real estate. Okay, that's ownership of a residential or commercial property or land. So if you own a home, you own real estate. There's a potential for return. in capital gains, which is selling the property for more than what was paid. You're not necessarily getting cash back from that, but you could be. Or rent. So you could own the property and charge others to rent it out if you don't live there. Okay, real estate can be time consuming. It can also be very expensive, but there is a potential for high returns. Speculative investments. Okay, speculation is when you think something is going to happen, but you don't really know for sure. These are high risk investments. They have a potential for significant fluctuations in return. So it's divided into three things. Futures and options are coming out of companies, basically what you think is going to occur within a company. Collectibles are items. Okay, these are items that you think may be worth money in 30 years. So if you have a very rare item from a football player, it may not be worth a lot of money now, but you're hoping, speculating, that it will be in the future. All right, so the type of return depends on which of these three things that you invest in. Okay, mutual funds. This is when a company combines the funds of many different investors and puts it into a diversified portfolio. So if you invest in a mutual fund, you can invest in one of these four things or all four of these things at the same time, with the potential to get each of these different type of returns back. So your advantage on a mutual fund is it reduces investment risk because you're not just investing in a stock, you're investing in maybe a stock and also real estate. All right, it saves you time as an investor because it's going into all things you don't really have to pick and choose. There is a disadvantage. Mutual fund investors that help you with this charge a lot of fees. So that's really your disadvantage. That, and sometimes the rate of return can be lower depending on which one you invest in. Ariana. Okay, we're going to go through this example. Ariana has $150 to invest. Her option number one is a stock. All right, so in this scenario, Ariana invests in one company's stock. Company C had a bad year and their market price drops. She could lose that $150 investment. But Ariana has $150 to invest, and now she's going to put it in a mutual fund across all these companies. Market price of companies C and F lost money, but all others, the other five, increased. So Ariana reduced her investment risk by splitting that $150 across companies, and she could still earn money from the positive growth from these five, even though there's negative here and here. Okay, so when you're investing, mutual funds can really be a good way to go. Index funds are a type of mutual fund designed to reduce fees by investing in the stocks and bonds that make up an index. Okay, an index is basically a group of similar stocks and bonds. So you're investing in stocks and bonds in one group of similar stocks. Okay, so an example, this is a stock that you will see if you look on CNN Finance, S&P 500. If you invest into there, you're going to invest in a group of similar stocks and bonds that are all grouped there. Okay, so a couple terms you need to know, lending and owning. When investing, consumers, you're either lending your money to the company or organization, or you own the asset. Okay, so examples of this. Lending is bonds. Okay, they're giving you that interest. Okay, there you go. You're lending your money to a bond. The bond is giving you interest. Okay, owning is a stock, real estate, or speculative investment. You own that, and you're going to get either cash, income from rent, or the capital gains. Okay, so a bond gives you back money on interest because you're just lending some money to them. Okay, and then you're done. After that maturity date, that bond's no longer yours. You get whatever interest money you make. You have that stock, real estate, or investment for as long as you want it when you own it. Okay, and there's your potential for return. So when you go to invest, you may be thinking, Mr. Corey, why are you even talking about this? You've been talking for 15 minutes about a bunch of nonsense because it builds wealth for you in the future, and you're going to thank me for this later. So when you want to invest and you have a knowledge of the general risk level of an investment, it helps you manage that. So you have when you do the lending on the bonds, you have a decreased risk of inflation. So you're not going to get hurt so much if there is inflation of other things in the economy. However, when you own, okay, real estate, stocks, mutual funds, whatever, Your increased potential for higher returns is there, but you also have an increased risk. So bonds are a very safe way to do it. These other three, real estate, stocks, and mutual funds, are usually a higher risk but higher return. So it's really going to depend on what type of loss you are willing to take. Okay, so characteristics of investment tools. I'm going to skip that. Investment philosophy. This is whatever philosophy that you're going to invest with. Everyone has a tolerance level for the amount of risk they are willing to take on. Okay, so it's conservative, moderate, or aggressive. And then time may influence how you want to invest. Okay, so you really need to think about what you want to do because you will invest in the future. If you are smart, you will invest. Okay, you want to think about, do you want aggressive, so high risk, high return? You want it moderate, kind of in the middle, or do you want it low return but very, very safe investment? Okay, so now portfolio diversification. This is going to be the last thing I talk about, and then I'm going to stop. Reduces risk by spreading your money among a wide group of investments. So the goal is that you have a whole collection of investments that will provide a decent return with a decent exposure to risk, and it reduces investment risk. So one of the things you want to do before you invest in your futures, I would suggest talking to somebody in the financial advisement business, because they can guide you on what might be best for you, what might work best for you. Think about what type of risk you want to take, how high of a return you want, and how many different types of things you want to invest in. If you do diversify it, like in a mutual fund or have mutual fund stocks and other things, you will have a higher chance of success with a lower chance of risk. Okay, I'm going to stop for today. Thank you for listening. And if you have any questions, please let me know. Have a great afternoon, Laurel Nakoma School.